Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Bank of Montreal topped profit estimates in the second quarter on robust fee revenue across capital markets and wealth management. Global markets and corporate banking were also up significantly from a year earlier. The bank increased its quarterly dividend by 4 cents per share. BMO's provisions for loan losses were also lower than expected. And profit in the latest quarter at Bank of Nova Scotia beat estimates thanks to strength in its Canadian banking division. It also announced an increase to its quarterly dividend of 4 cents a share. The bank says it expects to see earnings increase by double digits as it works to cut costs. On the downside, though, Scotia's provisions for credit losses were higher than expected. And U.S. Trade Representative Jamieson Greer says there is a path to preferential tariffs if Canada and Mexico cooperate with external tariffs on other countries. Greer is citing national security reasons to have America's supply chain sourced from North America. Ottawa recently signaled openness to that approach, but it wants to see lower sectoral tariffs on cars, steel, copper, and some other products. And we're watching U.S. futures in the pre-market, all trading in the green, but not by a lot, ever so slightly. The Nasdaq up by 0.6%. That's the biggest mover there. We're also watching the TSX today to see if it can make some gains after seeing some losses yesterday. The TSX fell by a couple hundred points yesterday, so we'll keep an eye on that when markets open in about half an hour from now. BMO, Scotiabank, and National Bank are kicking off Canadian bank earnings this morning. Looking at all the results, our next guest says a key takeaway was that the bank's fee-based businesses are remaining strong. So joining us now to break down all of these results for us is Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds. It's great to have you join us. Thanks so much.
Yeah, thanks for having me.
So we'll start there then. Why do you feel that that's a key takeaway for all of the banks that we saw report earnings today, all three of the big ones?
Yeah, so I think, one of the trends we've seen over the last several quarters, of course, is growth of a number of these fee businesses for Canadian banks, in particular their wealth management franchises and their capital markets businesses. Of course, wealth management has done very well across all the banks, particularly with equity markets moving higher, as we've seen growth in balances there, growth in client balances, and additional fee income through that channel. And then capital markets have been performing very well just on the back of increased volatility in the markets around geopolitical events and other things going on in the macro environment. That's driven pretty strong results across the board for all the banks, both in Canada and the U.S. On the trading side. And now we're starting to see a resurgence of investment banking revenues as well.
Yeah, and the banks trade at 15 times PE versus the historical range of about 11 to 13 times. What's driving that premium, and is that sustainable, do you think?
Yeah, I think it's one of the key questions this year. Of course, with the Canadian banks moving up something in like the 60% range on average over the past year, now trading at elevated earnings multiples, is that something that's sustainable? Well, I look at some of the drivers of those, and the key driver is improving return on equity. Now, why has return on equity improved across the banks? There's a number of factors. Like when it comes down to it, all of their businesses are performing well at the same time, which is not something we usually see. So one of the key drivers, of course, being interest income. Interest income, if we look back over the past 15 to 20 years, interest income is something that really suffered through the era of zero interest rates. When we look at how banks generally produce that margin, they're lending out assets at a higher rate than the deposits they take in. But when rates go to zero, you can't lower the deposit rate below zero, and so that lending margin compressed in the era of negative rate or era of zero rates. And I think now that we aren't going back to that environment, lending margins have improved. We haven't really seen a lot of loan growth yet, but I think that that's something that could be coming in the coming quarters and years. But ultimately, that core earnings power of the banks, that all drops to the bottom line because increased margins really don't come without the need for additional expenses. Now, at the same time of that, we've seen, as I mentioned, very strong fee-based businesses, which I think has driven earnings multiples higher. We've seen pretty strong expense management. So all the banks are producing positive operating leverage now, with moderating expenses sort of driven by efficiencies. Some of it could come through AI and other sources, but ultimately growing revenues faster than earnings, which is producing better efficiency margins for the banks, better return on equity. And then credit, which had been sort of weak for a number of quarters, has begun to stabilize, and that's something that could improve in the back half of this year and into 2027. So you put all these things together, banks are producing record earnings, record profitability, high return on equity that's moving higher. They have very strong capital levels, which support dividend growth and buybacks. And so you put that all together, I think you can trade at a multiple above that historic range of around 11 to 13 times. But I think the key question of today is will these results from the banks be enough to justify a 15 times earnings multiple, which is certainly elevated. And I think we'll see more as the trading day begins and as the rest of the banks report tomorrow.
Yeah, it'll be interesting to see how investors really treat these banks once the bell opens, once the bell comes a little later today. There's something you mentioned that I did want to pick up on. You said loan growth could be coming within a matter of years for some of these big banks. You went through a number of factors there as to why you feel like there's kind of a rosy outlook for these banks. So is that why, everything you just mentioned, or why do you feel like loan growth is coming in the next couple of years? Because we did hear from the CEO of Scotiabank really expressing optimism for the Canadian economy in 2027.
Yeah, I think ultimately it comes down to that a little bit of optimism around the Canadian economy. I mean, we've been stagnant on a per capita basis for a number of years. I think we're starting to do things as a country that are positive for growth. And ultimately, that will flow through to bank balance sheets. I think one area where they're maybe a little bit challenged on loan growth, of course, is the residential mortgage market. But I think they can make up for that in corporate loans and other parts of the market. And so, loan growth has been an area that has been challenged. But I think looking at the bigger picture, looking out to 2027, it's an area that could improve for the banks just on the back of an improving Canadian economy.
How are banks using AI to drive efficiencies on both like the cost side and the revenue side?
Yeah, I think that's a really key point there. Is you think about artificial intelligence, and you think of the first thing that comes to mind is job losses. What's going to happen with white collar employment. But I think when you talk to the banks and other companies that are deploying AI, and all the banks are very focused on deploying AI in their businesses, I think a lot more of the benefit comes on the revenue side than it does on the cost side. So you think about their sales force, like customer service agents, and their ability to service only a limited number of customers, and now deploying AI tools that may generate automated insights for those agents. You go into a bank branch and talk to the person there. They're able to generate automated insights on the spot to help cross-sell different products. So that's one area where we see that's really interesting, that could drive improvements in efficiency and revenue growth down the road. The other area, of course, for banks is on the compliance and fraud detection side, where there's a lot of paperwork that goes into compliance, a lot of time spent on administrative tasks, and to the extent that these new technologies and AI can help improve efficiencies there, we think banks are sort of at the forefront of the businesses that may be able to take advantage of that and really see improvement in profitability and see that drop to the bottom line.
Okay, we're going to take a quick break right now, but Mike, I know you're sticking around with us, so we'll go through the banks in more detail that have reported earnings this morning when we come back, so stay with us. Thanks for that. And we're going to continue our conversation with Mike after a quick break, so we'll be right back. Stay with us. Welcome back. We're going to continue talking about the Canadian banks that are reporting earnings today with Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds. Mike, thanks for sticking with us. So we'll get right to it. We'll start with the Bank of Montreal, seeing really a lot of strength in robust fee revenues across capital markets as well as wealth management, beating estimates on that. What's behind the strength in these areas in particular, do you think?
Yeah, so I think it was a pretty strong quarter for BMO across the board. In their wealth management business, they've got assets under management up 33% year over year, driven in part by strong markets that have driven client balances higher, as well as new growth in that business. So that's an area of the bank that is performing very well and should continue to perform well. The capital markets business is producing record revenues and earnings. It's very strong. In particular, BMO has a very strong mining franchise, which we think is poised to perform very well, just given everything going on in the mining sector and with the Canadian economy here. And notably, we've seen pretty strong or pretty solid results from their base U.S. Personal and commercial banking business as well, which was an area of the bank that was a little bit weak in past quarters and past years. Their earnings are now up 25% year over year in that business. We're seeing some moderate commercial loan growth there, which is a key positive. And I think that's an area of the bank that, if it continues to perform well like it did this quarter, will be a positive for the market and will be seen positively by analysts.
Looking at Scotiabank next, the company beat profit estimates and announced an increase to its quarterly dividend. But this news was kind of overshadowed by its provisions for credit losses in capital market divisions. So what's concerning to you about what we saw with Scotiabank?
Yeah, so if we look at the credit loss picture for Scotia, I think it's, if you look at just their top line provision for credit losses, it's actually down quite substantially year over year. But it's important to break that down into what's happening there. So banks will typically provision for impaired loans. These are loans that have stopped paying some form of payment or impaired in some other way, as well as they'll do a provision for performing loans, which is just based on the macro environment. So all the banks, including Scotia, last year in Q2 took pretty big performing provisions because of the tariff environment at the time. Now those have normalized, so the total provision for credit losses is down. But if you look at the details of impaired loan provisions for Scotia, they've actually continued to move higher quarter over quarter here, versus some of the other banks are reporting impaired provisions that are flat to slightly down. Now they've highlighted the international corporate portfolio as a key driver behind some of those higher impaired loans, and in particular, they've pointed to one specific customer there. So it may not be as bad as feared, but I think we'd like to see a little more detail there in terms of what's driving that, and is it an area of caution to look out for. The other thing you mentioned, of course, on the capital market side, capital markets businesses generally have been good across the banks, but we did see the quarter for Scotia below consensus on weaker trading revenues and higher expenses. These revenues and earnings from capital markets do tend to be a bit lumpy, so it may not be the start of a trend, but I think it's important to highlight that that's a key difference from the other two banks that reported today.
Yeah, so I want to get to National Bank as well. Profit and revenue beat expectations. What's driving these results?
Yeah, so again, pretty strong beat for National across the board, particularly, again, in the fee-based businesses. Wealth management had revenue growth of 14% year over year. And we've seen very strong results on an ongoing basis for National and their capital markets division, which is a pretty strong division for them. We've seen pretty strong trading revenues for a number of quarters. And importantly, now we've seen record revenues for them on the investment banking side, driven by sort of all lines of business there, whether it's corporate banking, M&A, as well as equity capital markets. And so that's really what's been driven the strong revenue side there, as well as they've got pretty good expense management. And their credit losses, I think here were a pretty strong result. Look at their impaired loan provision for credit losses are at the low end of their guidance range for the quarter, which is a pretty strong performance relative to Scotia in particular, but as well as BMO.
Your view on National Bank, though, is mixed despite the beats. Why is that?
Yeah, I think it's mixed there because I think the one negative you could maybe point to in the quarter was they did have a lower net interest margin and lower net interest income, which I think would be viewed somewhat negatively by the street. They have their conference call later this morning, so I think it'll be important to ask a few more questions about that to see what the key drivers were there. But really, it's a strong business, trades at an elevated multiple, so just sort of not sure there's enough there to really push the stock higher here. So some good and some bad, but ultimately like a pretty solid quarter for National Bank.
Okay, lots to discuss here. Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds. Really appreciate you sticking around. Thanks so much.
Thanks for the time.
Up next, could AI end up creating more jobs than it eliminates? More on that just ahead. Stay with us. Mass layoffs across big tech, from Oracle to Meta to Amazon, are reigniting fears that AI could replace workers. But is that only part of the story? OpenAI CEO Sam Altman, who once warned of significant white-collar job losses, now says the risks may be overstated and a jobs apocalypse isn't on the horizon. For more, we spoke with Jeffrey Roach, chief economist at LPL Financial.
It has not been and has not generated an apocalypse for labor demand. So he's exactly right in that sense. Now, granted, the impact from AI is not altogether straightforward. It certainly augments the demand for certain categories of workers. And unfortunately, it does automate and replace other categories. So it's very possible that if you're in a job where you can be more efficient and more opportunities to use your high value output, you could actually see an aggregate in the economy and an increase in demand for workers, not necessarily an elimination of them.
Okay, the last U.S. jobs report had unemployment at 4.3%, so below historical long-term average. You mentioned that it's not really clear. We're not seeing the clarity around job losses in AI. Why do you think that is?
Well, I think it's because you think of a job, it's a bundle of tasks. We don't often do just one thing. And if you do, then that's the highest risk of being automated. I think one factor as well, in terms of the very, very low unemployment rate we see, is the fact that we have a shrinking labor force in general, an aging population. And so just the sheer demographics explains the fact that we can see a declining unemployment rate and yet not necessarily a clear picture on where the job market is. In addition to that is you also see some varying impacts depending on the age of the worker. So new entrants coming out of grad school or undergraduate, you're going to have a tougher time. The job market is not as good. However, if you have a few years experience, you're in the 35 to 55, it's interesting to see that the increase in demand for that category of worker. And it does make sense when you think about the nuances involved in a typical job. If you have the experience, AI can allow you to be more efficient, hence the increase in demand for someone like that.
When you look at this, I'm wondering if you look at sector or skill set, how are you, when you're looking at what jobs are going to be created versus what jobs are going to be eliminated? You mentioned high value jobs, for example. Can you just expand on what that looks like for you?
Well, it's very likely that certain jobs don't exist today that will exist, say, in 5-10 years. I think there's a great stat out there that struck me when I first read it. When you think about 60% of jobs today did not exist in our grandparents' age. I think that's very telling, and it really, I think, reveals the dynamic nature of the labor market. And that's one of the reasons why I think there's still a lot to be seen and a lot of unknown. We truly don't know the full impact yet of AI, particularly on efficiencies and labor market demand.
Yeah, we have seen, as we talked about at the start of this, some of the big technology companies, of course, wanting to spend more money on the build out, and so they're doing layoffs there. We're seeing some of the backrooms of financials benefiting from AI and letting people go as a result of that. But because the build out is still going on in such a big way, is it possible we could have this big fall off of jobs all at once at some point in the future?
I don't think that's likely. I think it will be more gradual because there's a gradual phasing in of the application of these AI agents and usage of them in industries. And so in essence, that does give us time for us to to just observe the different impacts across industries. So I think that's one way to kind of calm fears. That, going back to your initial point in the beginning of the interview here, it's not an apocalypse, because I think we're seeing a progression. Now, granted, I think we can harken back to history. If you're a telegraph operator and you see an improvement in technology or a new technology coming to market, yes, you will no longer have a job in that sense. So there are certain categories that have risk, and we've already seen that already. But we don't know in some of the more complicated multi-tasks of a type of job. We just haven't seen the full impact quite yet.
All right. You referred to this, and I'm wondering if you can tell us more how AI can help governments, for example, cope with populations that are shrinking, either because they aren't getting as many immigrants coming in or because their populations are getting older and getting out of the workforce. So how can they be helped in this way?
Well, that's right. I think the improvement in technology allows us to see an improvement in productivity. And I think that's exactly what needs to be seen when you think about an aging population and you have a shrinking labor force. The only way to get solid economic growth is to see a spike in productivity. Now, we've actually seen some improvements in productivity over the last couple of years, specifically the years following COVID during the work from home. In fact, there's been some really interesting research done on hybrid work allowing for greater productivity. So I think the fact that we're seeing the infrastructure and the tools being laid out for a smaller labor force to increase productivity and to continue to grow an economy.
What about for earnings? What should investors expect when they're looking at how earnings could change as a result of AI?
Well, certainly look at the details of the cost structure. Our firm's managing costs, not just labor costs, and this is where there might be some improvement, but also capital expenditures. Are they using the build out of AI wisely and setting the stage for improved efficiencies and improved profit margins? I think that's where you need to look for it as an investor.
That was Jeffrey Roach, chief economist at LPL Financial. Okay, we want to take a quick look at Lululemon because this company making some news this morning. It's up in the pre-market. So Lululemon has actually settled a dispute with its founder, Chip Wilson, by overhauling its board with 3 new directors. The company will now name 2 of Wilson's nominees to the board. Under the terms of the deal, Wilson has also agreed to a standstill clause lasting about 18 months, which includes not disparaging the company. We know he's been quite vocal in the past, specifically about the search for a new CEO and how the company should move forward. Shares rose as much as 3% in pre-market trading, and we'll continue to watch that throughout the day. Stay with us. The opening bells are next. Here are the opening bells at the NASDAQ. Boost Run is ringing the opening bell this morning. On the New York Stock Exchange, America Mobile in celebration of its 25th anniversary of listing. And on the TSX, JP Morgan Asset Management is opening the market. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway. So we're going to take a look at the equity markets this morning. The TSX seeing a bit of a loss so far this morning. Saw some losses yesterday as well. We'll see if maybe it can rebound today. American markets are up a little further, not by much though, trading pretty flat to start the morning. We'll continue to watch that for you, of course. We are watching some big Canadian companies, and of course, some of the big banks have started reporting Q2 earnings today, and we're watching those closely. Bank of Montreal beat estimates on capital markets and fee revenue in the second quarter. The bank is raising its quarterly dividend from $1.67 to $1.71. And you can see so far today, it'll be interesting to see how investors react to this news. So far, BMO trading up ever so slightly. Scotiabank also reported beat estimates on its Canadian and international units, and it's raising its dividend by about 4 cents as well. The CEO today expressing relative optimism on the Canadian economy in 2027, citing a business-friendly government and oil exports. But we know Scotiabank set aside about $1 billion in provisions for loan losses in the quarter. So it'll be interesting to see how investors react to that. So far up by 0.5%. National Bank is the other big one that has reported today, also seeing a beat in overall strength in major segments, but a modest miss in core personal and commercial banking. And National is also raising its quarterly dividend by 8 cents. And we're watching some U.S. companies as well. Micron Technology, south of the border, is one that we're watching closely. It is extending its AI memory rally after another major move higher. So up today already by more than 7%. We'll continue to watch that one for you. And we're also watching a couple of airlines in the United States because they were down earlier today. United Airlines, American Airlines, and Delta all down in the pre-market. Now they're trending up again. So United Airlines up by more than 3%, Delta up by almost 2%, and American Airlines up by just over 2%. Coming up, second quarter earnings from Scotiabank, BMO, and National Bank after this. Canada's big six banks are turning in their second quarter earnings results. Scotiabank and BMO beat year-ago earnings by wide margins. Both banks point to wealth management and fee-based businesses as key drivers of growth. Let's get more now from Grant White, portfolio manager and investment advisor at Endeavour Wealth Management. Good morning. Thanks for joining us.
Yeah, good morning, Lindsay. Thanks for having me.
So let's start with Scotiabank, because this is a name you like. What drove the quarter, do you think, for Scotiabank?
Yeah, I mean, I think they've done a really good job, especially in getting loan loss provisions down. And so, we're really excited about what the earnings report did. It actually moved them up on the scale for us. We did like them before, especially from domestic bank. I think there were still some question marks that we had about Bank of Nova Scotia, and those are largely cleared up from this report. So all things are looking really good for Bank of Nova Scotia, and I think shareholders should be very happy with what's going on there.
On credit, though, Scotiabank set aside more than $1 billion in provisions for loan losses in the quarter, which is more than forecasted. Why do you think that is? Is this a broader sign of the Canadian economy right now and moving forward?
Yeah, I mean, I think that's the question, right? I mean, absolutely. I think it shows what they're thinking about, and they're expressing that there's a lot of the same challenges that we're seeing out there in the economy, and that maybe people aren't doing as well, and so that is something that we need to be a little bit more aware of and be cautious about. But at the same time, I think they're being prudent. They've shown to have strong management around these things, so I'm not overly worried about it. In fact, I think that's more of a sign of again, more prudent management as we go forward here. But it's definitely a sign of where they see the economy at, and I don't think that should be a surprise to anybody at this point.
Okay, because I was going to ask why BMO National Bank didn't exactly do the same thing, but you think this points more toward the management within Scotiabank?
I think it points more towards the management in Scotiabank, but I also think it points more towards the actual quality of what they've got going on and the domestic nature of Bank of Nova Scotia as well. So for all those reasons, I mean, I think they're holding a little bit more risk, and this is why I'd have them a little bit lower down the buy scale, if you will, as compared to BMO and National Bank as well. But that's all to say it's a pretty relative risk table, if you will. And I still feel very confident with Bank of Nova Scotia going forward. And again, I think their management's quite strong, and they've shown that. So. Okay,
BMO now also reported a beat, especially in its U.S. banking segment. What jumps out to you in this earnings report?
Well, I think capital markets has proven to be really strong for BMO once again. I mean, one of the reasons we like BMO is that U.S. banking side. I mean, it's a nice diversity. It's some nice diversity from especially a domestic bank. And I really like the fact that I think that the U.S. is going to continue to be really strong economically. And again, pointing to some contrast here with Bank of Nova Scotia, I think BMO is going to weather this a little bit better just because of that U.S. strength. And so again, I think they're very strong. And we've owned them for quite some time. And again, after this report, I think not only is that proven well for our ownership, but I think it's pointing to signs that we're very confident owning this going forward and buying more into it.
How sustainable, though, are the current earnings levels for both BMO and Scotiabank?
Well, I mean, I think they're sustainable, given what we're seeing out there in the marketplace and economically. I mean, it doesn't mean that there's going to be a straight up line here, and we never expect that, to be quite honest. But, again, I think you can feel very confident about the way that BMO has continued to manage things over time. And I think that, although we might face some headwinds at some points along the way, we might not at the same time. I mean, nobody really knows what's going to happen in the next few months. And so I think we're very confident in their abilities to navigate whatever it is that we're going to face. space. But I do expect some volatility as we go along here. And I would treat that as buying opportunities, especially with a company like BMO.
Okay, National Bank as well reporting lower than expected credit losses, a modest miss in core personal and commercial banking. What stood out to you in this report?
National Bank continues to be, I would say they're a bit of a standout here, to be quite honest. They have such strong leadership in that company. They continue to be very, very strong quarter after quarter. And what stands out here is the wealth management side of their business continues to do very, very well. And it's, so I think that they've continued to do well in that space. And they chug along. Now, they don't have the same advantages some of the other banks, including on their diversity in terms of revenue streams, but they're very focused. They're very disciplined, and they continue to make big gains in certain areas. And so I like that nature of National Bank. And because of that, actually, if you're comparing all three of them, a National Bank, I think, would be the top pick for us right now, just given how they've been able to perform here. And I think what we expect from them going forward.
Okay, you do have some stock picks today that I wanted to get to. They're not in the financial sector,
Sure.
so let's talk about those instead. Canadian Natural Resources is your first pick today. So tell us about why you like Canadian Natural Resources, particularly what we're seeing with the price of oil right now, too.
Yeah, so Canadian Natural has been a company that we've liked, again, for a very long time here. I think this story is coming back again because, what we're seeing in the energy marketplace, given with the conflicts in the Middle East and everything we've seen. I think why I like this so much today is just because we are seeing new deals coming up. We're seeing big announcements out of Germany buying, natural gas from Canada and new prospects of new deals going forward. We liked Canadian Natural for a long time already, and we continue to like them going forward. And we like them even more given the environment for energy today. And so I think CNQ is going to do very, very well. We're also seeing a really nice price point here. I wouldn't say they're overly cheap, but I think they're very fairly priced. You're getting a really nice dividend or nice yield when you factor in their dividend and their buyback yield. So you get paid to wait on this one at the same time. But really, there's a lot of tailwinds that are forming up behind Canadian Energy, and CNQ is frankly one of the best in the business.
Is that the same story for Tourmaline Oil then, that you've always liked them, but now you like them even more given what's been happening?
So Tourmaline, I wouldn't say I've always liked Tourmaline, but we certainly like them today, and we have liked them for the last little while. A lot of the same drivers are behind Tourmaline as CNQ for sure. This is more of a pure natural gas play though, and so if you're buying into the natural gas story like we are, then Tourmaline is more of a bit of a pure play on that. It's not an oil business, and so if you look at pricing, especially right now, Tourmaline, is trading at a great price, and they've also been proven to be a low-cost producer. So even if we do see price volatility, which frankly we're not expecting given what we're seeing out there in the world, but if we did see price volatility, we expect Tourmaline's going to be very profitable at that. And if prices remain elevated like we're seeing today, they should do very, very well. And so for all those reasons, I would say, you can feel very confident with CNQ. It's a really stable company and it's a good core holding, but you could also feel very confident with Tourmaline going forward as well. And I think you're going to do very well there.
Okay, Grant White, Portfolio Manager and Investment Advisor at Endeavour Wealth Management. Always great to have you on. Thanks so much.
Thanks, Lindsay. Thanks so much for having me.
Yesterday on Market Call, we were joined by Ryan Modesto. He is CEO and Portfolio Manager at I2I Capital Management, and he was covering North American stocks. These were his top picks: Kratos Defense and Security Solutions, Talon Energy, and Invent Electric. Today on the show, we have Mike Philbrick. He's CEO of Resolve Asset Management, and he'll be taking your questions on ETFs. Just ahead, Canada has entered into negotiations to buy Saab's GlobalEye military surveillance planes and not go with a U.S. manufacturer. More on that after the break. The Prime Minister just spoke at CanSec, Canada's largest defence and security trade show, where he announced new measures to make Canada more secure, resilient, and prosperous. For more, we're joined by CTV's Rachel Ayala. Rachel, good morning. Great to have you join us. So what did we hear from the Prime Minister just now?
Yeah, good morning. Thanks for having me. So what we heard from the Prime Minister was an announcement that Canada is entering negotiations to procure Saab's aerial surveillance system known as GlobalEye. This is a high-tech surveillance system that is actually put into Canadian-made Bombardier jets. So this is an example of the Prime Minister wanting to further link the European defense sector and Canada's defense sector. And Lindsay, specifically what the Prime Minister says Canada is going to be negotiating for here is for that there to be about 1/3 at least of the jets that are going to be made in this fleet over the next 15 years. That would be about 40 jets to be made in Canada, and that would be, the government says, employing around 3,000 Canadians. And this is a step towards the federal government making it clear that they are willing to diversify who they are doing defense contracts with, because in making the decision to go with Saab's aerial surveillance system, this early warning and advance notice system, they are essentially indicating to U.S. supplier Boeing, that they won't be going with their option. This comes as the Prime Minister is actually about to get on a plane this afternoon and go to New York. So a clear example from the government here, making a point of saying that this is the first time the Prime Minister has actually spoken at CANSEC, an emphasis on how seriously the federal government is taking the myriad of defense procurements that they're going to be making over the coming weeks and months.
Such an interesting update after we saw the King and Queen of Sweden visit late last year, kind of trying to push this on the government here in Canada. Okay, so staying with the federal government, we've got some other news that we're watching closely today. That's longtime minister, former Environment Minister Stephen Guilbeault set to make an announcement later this morning. What exactly do we know about what he's going to say?
Yeah, so what I can tell you is that as we are speaking, if not imminently, Stephen Guilbeault will be inside the Liberal caucus room, a meeting of all Liberal MPs behind closed doors, in which we are told he is going to be informing them that he is resigning his seat as a Liberal MP and leaving federal politics altogether. This is a move that comes after he first stepped out of cabinet over his concerns about where the Carney government was going on the environment, concerns about some of the environmental policies, and of course now, as we've seen the government pursue even further some natural resource development, specifically talking about a pipeline with Alberta, Stephen Guilbeault has decided that he no longer wants to be part of the Liberals, a big loss in terms of the progressive flank of that party. And so Prime Minister Mark Carney, after making that announcement at CANSEC, did take some questions, and he said that he wishes Guilbeault well, thanks him for his time in government, reflected a bit on actually their work together before Carney became the Prime Minister, and said essentially, every person has the right to make decisions about where their career is going, and express some optimism, Lindsay, that perhaps they could work together in some capacity in the future. So certainly a gracious comment from the Prime Minister in respect to Guilbeault, but we're watching this afternoon to see what he says publicly in terms of making this resignation clear, timing of it, because then, of course, that would trigger another by-election.
For sure. Okay, we'll leave it there for now. CTV's Rachel Aiello joining us live. Rachel, thank you.
Thank you.
We're going to stick with that defense theme for a moment that Rachel was talking about. Ukraine, meanwhile, is turning to Canada for drone production, partnering with Ontario-based Sentinel R&D after years of building them at home. So for more, we sat down with Walter Dorn, professor of defense studies at the Royal Military College of Canada.
If Ukraine can have a manufacturing capacity outside of the country, then it won't be subject to Russian attack, and it can be revenue generating. And in addition, the Canadian government can be funding Canadians to be developing drones and gaining expertise while Ukraine actually gets those drones. So in fact, those are Canadian paid for drones manufactured in Canada under the current vision, and that Ukraine would then be able to use them in their fight against Russia.
What led to Ukraine making this change in policy?
I think President Zelensky started to go from a more introverted, let's do everything to win this war, to saying this is a longer-term war, and we're going to need to have an industrial base that's just wider than what they have in the country. So they started to reach out, and they realized that the Ukrainian people and military had created a fantastic capacity that other nations wanted. So it wasn't just Ukraine going with a begging bowl to other countries, but saying, look, we can actually come up with joint ventures with win-win kind of industrial partnerships that can help not only Ukraine, but the other countries, and that will make it much longer lasting.
Yeah, let's talk about Sentinels. Their drones, I understand, can be used for many different things. Are these the kinds of drones Ukraine is used to deploying, or are they used to deploying more specific of these crafts?
Well, Sentinel R&D is a startup Canadian company without a long track record of producing drones and putting them in the field. But they will be using Ukrainian designs for the airframes. And they're the Ukrainians, although that company in Ukraine Airlogics has only been in existence since 2020. They now have a huge amount of experience, more than 50 personnel, and they will be providing a lot of expertise for the Canadian companies. So essentially, we're providing a manufacturing capacity and hopefully some innovations in the form of composite materials that can be used to make the drones. And Canada also produces some pretty excellent cameras, so perhaps those can be incorporated into future drones. But right now, it looks like most of the expertise is coming from Ukraine.
Do we need this? We talked about the benefit to Ukraine. You talked about what Canada is gaining, but is it something we need?
Oh, for sure. Yeah, the drones are the future of military operations. There's going to be a huge revolution in military affairs. We're already seeing on the battlefield in Ukraine. The Canadian military has a long way to go till we've incorporated drones into our own battle procedure and using them in swarms for intelligence gathering, using loitering munitions, using them for long-range patrols, particularly in the Arctic or off of the second largest coastline in the world. Drones are really going to be important for Canadian defense in the future, and so we need to up our game in this area.
Walter, is this the only partnership Ukraine has opened up to, or are they partnering with other countries as well?
Oh, no, they've really opened up a lot. They've already made deals with countries in the Persian Gulf, or let's just say the Arabian Gulf, and those are for counter drone technologies and counter missile technologies. They've worked with German companies to create loitering drones. It's a major initiative that President Zelensky launched last year to be able to do these joint ventures, and it's already bearing significant fruit for Ukraine.
Could the involvement of Canada partnering with Ukraine on this affect our relationship with Russia? Is that something we need to worry about?
I think we're already very much in the Ukrainian camp. We are solidly on the side of Ukraine and in the defense of its territory. And I don't think that this kind of industrial partnership would make Russia see us any differently. If we put our own personnel in the field, if we deployed people to help with the actually running of those drones inside of Ukraine, then yes, the Russians may see us as being part of the combatants. But right now, just as a manufacturing base, that would not be a strong worry for that Russia would then see us as a combatant or someone to attack.
What's the timeline on these drones being made in Canada and sent to Ukraine?
Well, we only will see the signing of an agreement at the Canadian Exposition next week. CanEx and Security and Defense will be exchanges of industrial notes, and we have to see that the Canadian government, through the Department of National Defense, is funding this. Then there have to be export permits. So I would say that we might hopefully see the first drones in the beginning of next year, but that's dependent on a lot of factors, and I wouldn't be certain about that.
That was Walter Dorn, Professor of Defense Studies at the Royal Military College of Canada. Coming up, will the Canadian host cities of this year's FIFA World Cup follow New York's lead with a plan to offer discounted tickets to local fans? We'll find out. New York's plan to offer discounted World Cup tickets is raising expectations in other host cities. Vancouver holds about 9,000 tickets, most purchased by the city, with no freebies for officials or staff. The key question is, how will these tickets be distributed to the public? CTV's Andrew Johnson has more.
A World Cup win for New York City's mayor.
These 1,000 tickets are going to be split into batches of 150 tickets for each of the 5 group stage matches and 2 knockout round matches in New York, New Jersey, and tickets will cost only $50.
New Yorkers priced out of the World Cup have a shot every day this week at $50 tickets in a daily lottery.
If I win, I'll be there.
Mayor Zoran Mamdani negotiated the approval to sell discount tickets to the public with FIFA President Gianni Infantino. That got us thinking about Canada's two host cities and why affordable tickets are not being offered to the public here. We asked the Vancouver Host Committee about that. Here's what we learned. The municipality is in possession of 9,000 match tickets across Vancouver's 7 games. Of those, 1,600 were provided to the city by FIFA and 7,400 were purchased by the city. The host committee says the majority will be sold off through its sponsorship program to help offset hosting costs. This urban planning specialist doesn't like the look of those optics.
So purchased with taxpayer funds, but we don't know how much they're actually going to charge, right? I don't even know if we know how much they paid for the tickets. And to do so in a way that is transparent and honestly just fair.
When we asked how much the tickets are being sold for, we were told in an email that's confidential.
So this is not the way government is supposed to work.
Vancouver says it is providing up to 350 tickets for young people who face barriers. Toronto's host committee is expected to provide ticket data tomorrow. Andrew Johnson, CTV News, Vancouver.
Just ahead, we've got more on Canadian bank earnings and the tech rally rolls on. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Canada has entered negotiations to buy Saab's Global Eye aircraft. The advanced aerial surveillance system is developed in Sweden and will use Canadian-made jets. Prime Minister Mark Carney says the federal government is negotiating a deal that would see at least 1/3 of the projected fleet manufactured in Canada over the next 15 years. Once the contracts are signed, Bombardier could be manufacturing at least 40 aircraft in its plants in Montreal and Toronto. And we are watching shares of Scotiabank today. Profit in the latest quarter beat estimates thanks to strength in its Canadian banking division. It also announced an increase to its quarterly dividend. On the downside, the lender's provisions for credit losses were higher than expected. And Bank of Montreal topped profit estimates in the second quarter on robust fee revenue across capital markets and wealth management. Global markets and corporate banking were also up significantly from a year earlier. BMO's provisions for loan losses were lower than expected. And we're keeping an eye on the TSX today, seeing some losses. It appears it's being dragged down by the energy and materials index so far today. This comes after it saw some heavy losses yesterday as well, a couple hundred points. We'll continue to watch that for you. Also watching U.S. markets. They are in the green so far today, but trading basically flat at the moment. Shares of Bank of Montreal are trending higher after reporting a 30% rise in second quarter profit year over year and hiking its quarterly dividend. And National Bank beat expectations for its second quarter profit and revenue. So let's get some perspective. For more, we're joined in studio by Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Great to have you in.
Thanks for having me.
Let's start with National Bank. How would you rate the quality of the earnings beat you saw from this bank?
It's a really nice top line beat. You know, they're making money in capital markets and investment management, which you would think. I think the question is, are they over-earning? And, you know, Jamie Dimon in the States this morning came out and basically said banks are over-earning because of what's happening within the capital markets. You know, we have a mix in Canada on loan loss provisions. And you know, really it comes down to what do we think the economy is going to look like in 27 and 28. And, you know, I think the Canadian banks are going to be okay. I think I worked for a bank in my previous employ. They can pick whatever numbers they want to generate through their accounting, right? So Canadian banks are well managed. The dividends are safe. They're very expensive, and they may be over-earning given what's going to happen in 27 and 28.
Are there repercussions, or when will we start to see the repercussions if they are over-earning?
Well, we really need to see what's happening with Prime Minister Carney's economic strategy and industrial strategy. Like you talked about, what was the 40 planes that are going to be manufactured. Look, there's this old Monty Python skit called The Parrot with Michael Palin and John Cleese. Yeah. I come up here, I worked in the States, I come up here and everybody says that, barely economic growth, full-time employment basically declining is strong. And we have forward guidance from the Bank of Canada saying that we should raise rates. And that's the private sector in this country is the parrot in the skit, and the parrot is dead. Okay? And now you have the Bank of Canada coming out basically saying they're going to raise rates because of what's happening in the Strait of Hormuz. Mm-hmm. Well, that is a classic Keynesian policy mistake. And the credit markets are going along with Macklin and saying they're going to raise rates. So let me say, if the Bank of Canada starts raising rates, then the private sector that is already in a recession is going to be hurt further. So that's where I get a little bit conflicted. I think the banks are fine right now. Mm-hmm. We are standing in front of a massive policy mistake with the Bank of Canada if they go through with it. And then at the same point in time, we really don't know how quickly we can get projects and private sector capital to come back into Canada to help rebuild and restructure Canada.
I want to get back to that point in a little bit because we do want to talk about that. But I just want to ask you about BMO as well, because I asked you about National Bank. So BMO, beat expectations, hiked its dividend. What were your takeaways from the earnings we saw?
Same thing,
Montreal? High
quality. But look, they're trading at a multiple of tangible book that we haven't seen in decades. Wonderful company, okay? Strong management, exposure to capital markets, right? They're over-earning in their portfolio of mortgages up here because everybody's refinancing their mortgages that were priced in off the COVID lows. All Canadian banks are getting a push. That goes away next year. So that's why you sit there and go, they're over-earning right now. They were fine in the quality. And at the same point in time are the loan loss provisions, are they, some are increasing, some are decreasing. What does 27 look like? So yeah, is it fine? Sure. Should you want to sell them? Like up here in Canada, everybody loves the banks, right? Doesn't matter what they do, okay? Dividend safe, extremely expensive, high quality earnings, over-earning. What does this look like in 27 and 28? Because if you're allocating capital today into the banks, you're making a statement about what's happening next year and the year after.
Were you surprised, like you say, with loan loss provisions, some were increasing, some decreasing? Were you surprised to see that with the three banks that we've seen report today, and that they're not kind of streamlined a little more about what they think the future holds?
That's capital markets, right? We have a divergence in views. But what I would say to you, the capital markets are thinking we're raising rates. I don't know. Let me be. Next time you talk to somebody that's managing a book, ask them about all of the real estate products they have that are gated. Okay? And you sit there and say, Bank of Canada's out there saying, this is great, everything's fine, real estate is good. And then you have a product over here, a real estate product over here that is gated. So when I came back from the States and I came up here, I said, this is a train wreck waiting to happen. Now what's happening is that the parrot is dead, using the Monty Python analogy, and yet everybody's around acting like Michael Palin saying, no, it's not. The economy's robust. It's not. It's not. And the Atlanta Fed GDP tracker is going to have the United States real GDP tracking at about 4.5%. And we're bouncing along zero, saying happy days are here again.
Mm-hmm. Okay, so I did say I wanted to get back to this point. You were talking about Canada and the announcement that Prime Minister Mark Carney made today, how Canada is trying to allocate more capital. You've also been following Alberta's plan for a referendum question on separation pretty closely. I wonder, how does that play into Canada trying to attract more investment at a time, a lot of investment maybe won't come to Alberta for a pipeline project if there's thoughts of a separation or, if Alberta looks a little uncertain?
I think it forces the issue. Think about this.
What issue? The
issue of so a couple of things. Well, we've got Mr. Guilbeault basically resigning, and I would suggest to you that he was a forcing function on carbon credits and having our industrial policy based off of the climate change, right? The Strait of Hormuz and what's happening basically has moved energy security to the top. And then we talk about the fact that, hey, you know, Germany's going to sign that deal with Canada for LNG, but we're going to ship it from the Pacific coast. Why not have an LNG terminal in Eastern Canada closer to the market? So this is an example of people in denial of the structural decisions that we made over decades that are now coming home to roost. I think Mark Carney understands that. I think he's got a cabinet that is still part of the Trudeau NDP extreme progressive left. He needs to manage it. And in my perverse way, I think the separatist movement in Alberta is providing him air cover to move back to the center. I think he's a reluctant pragmatist. He's going to do it. The question, even going back to the banks, is this going to take too long to save the Canadian economy in 27 and 28? So I think Carney's doing as best as he can. I do not think they're going to separate. I spend a lot of time in Calgary, but let's be honest. Folks in Calgary are really, really upset. This goes back to Peter Lougheed, right, and the Trudeau NDP coalition that basically affected their standard of living for 10 years. It's still tastes in their mouth. So I think it's helpful for us to structurally adjust. So are they going to separate? I don't think so. But I think it puts everybody on call saying we need to adjust now. And I think things are happening in the right direction.
Okay, we've got to leave it there. Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Thanks for coming in. Appreciate it.
Thanks for having me.
Coming up, we've got a new national poll revealing that AI in healthcare isn't anything new. Canadians are already using AI for medical advice, but that doesn't mean they trust it. We've got more on that after the break. Stay with us. Okay, let's take a look at some of the notable analyst calls and recommendations, starting with RBC Capital Markets, which has cut the recommendation on First Capital Real Estate Investment Trust to sector perform from outperform. PT set to $24.40, implying a 3.7% increase from the last price. National Bank, meanwhile, has cut the recommendation on Transat at Incorporated Class B to underperform from sector perform. PT set to $2.25, implying a 17% decrease from the last price. And RBC Capital has upgraded New Farm to outperform from sector perform with a price target of $3.60. That's up from $3.40. The revised capital efficiency focus on margins over volumes, cost reduction program, and lower CapEx outlook should provide a solid near-term trajectory of improved returns under normal and seasonal and market conditions. That's according to the analyst who told investors in a research note. William Blair downgraded Vera Mobility to market perform from outperform without a price target. The loss of a rental car tolling customer, Avis, is a major blow. It's according to the analyst. And Hovde Group analyst David Bishop has downgraded ACMB from outperform to market perform and has raised the price target there from $56 to $57. Okay, stay with us. We're going to take a quick break. We'll be back. Canada has entered negotiations to buy Saab's GlobalEye aircraft. The advanced aerial surveillance system is developed in Sweden and will use Canadian-made jets. Prime Minister Mark Carney says the federal government is negotiating a deal that would see at least 1/3 of the projected fleet of the aircraft manufactured in Canada over the next 15 years. Once the contracts are signed, Bombardier could be manufacturing at least 40 aircraft in its plants in Montreal and Toronto. And shares of Lululemon are rallying today. The retailer says it has reached an agreement to end its feud with founder and largest individual shareholder Chip Wilson. The company has agreed to appoint 2 of Wilson's nominees to the board. A product and brand expert will also be appointed. In exchange, Wilson has agreed not to criticize the company in private or public for the next 18 months. And shares of Target are moving higher today after the company said it is aiming to improve workers' customer service skills. Employees will be tested on how they greet, help, and engage with shoppers in an effort to make service more consistent across stores. Target says elevating store experiences is one of its top priorities. The move comes as the company hopes to turn around years of sliding sales. And we're taking a look at North American markets now. The TSX lagging today. Materials and energy indexes particularly dragging down the TSX after it saw some losses yesterday. We'll continue to follow that. S&P 500 and the NASDAQ both in the green, but really at this point trading pretty flat this morning. A lot of investors watching what's happening in the Middle East. Iran has confirmed that a peace deal, talks for a peace deal continue between the U.S. and Iran, despite those strikes on Iran yesterday by the U.S. Liaison Strategies is releasing a new national poll on AI in healthcare. It paints an interesting picture on how Canadians are already using AI for medical advice. For more, we're joined now by CTV's Renee Rogers. So, Renee, Liaison Strategies out with that new poll examining Canadians' use of AI in healthcare. Walk us through the highlights.
Hi, Lindsay. Well, this poll basically is showing us that while Canadians are largely not on board with AI outright replacing human health care, they are using it to fill a gap that has been created by a lack of access to timely health care. Let's bring up our first slide, and I will show you what I mean. So it shows us that 47% of respondents said that they would rate their current access to a family doctor or clinic as poor. And roughly the same amount, 46%, say that, yes, they have used an AI chatbot for medical advice in the past year. A slightly lower number, 42%, say they'd even be comfortable with AI scanning their x-rays or their skin for skin cancer before they get in to see a family doctor. So the survey's showing, Lindsay, Canadians are at least open to incorporating AI into their medical care, but that openness is only going so far.
Yeah, and what else does the survey really reveal about how Canadians use AI for medical assistance?
So, there is some willingness to embrace it, but Canadians aren't necessarily putting all of their trust in it, put it that way. We've got another slide here to show you. Less than 39% say that they would share their medical records to help improve AI, even if those medical records are anonymous. Just under a third, 31%, would allow AI to take notes during a doctor's visit. Only about a quarter, 27%, would prefer an immediate diagnosis over waiting for a doctor, and only 13% would be comfortable just with a complete AI experience, a diagnosis and a prescription, no human doctor involved. Now, this survey, of course, is coming as we're seeing rapid advancements of artificial intelligence in the healthcare system here in Canada. We've seen it help reduce the administrative burden. We've seen it help predict patient outcomes. But that being said, despite those advancements, Canadians not really willing to let this replace their human doctor.
Interesting stuff. Probably a good thing at this point. Okay, CTV's Renee Rogers joining us live. Renee, thanks for that.
You're welcome.
A landmark ruling recognizing Indigenous rights over 800 acres of Metro Vancouver has triggered political upheaval in Canada. The government now must reconcile Aboriginal title with existing owners. Bloomberg's Thomas Seal has more in this report.
An Indigenous group has won legal claim to hundreds of acres of Metro Vancouver, including this area right behind me. That case, and others here recently, have gone further and faster than many here expected, and now it's causing a big backlash. The ruling has triggered widespread uncertainty about its potential to upend property rights here on Canada's prosperous west coast. In 2014, the Cowichan tribes filed a lawsuit against Canada seeking recognition of their traditional lands near Vancouver and a right to fish the south arm of the Fraser River. The case involved 513 days of hearings, with almost 3,000 exhibits of evidence and documents. Finally, last August, the Supreme Court of British Columbia ruled that, in the mid-19th century, the colonial governor set the land aside to be an Indigenous reserve, but government officials at the time instead allowed it to become private property. Unlike the rest of Canada, the Crown did not sign treaties with most of British Columbia's 204 First Nations during colonisation, meaning their relationship is still in flux today. The judge cited Indigenous rights in Canada's constitution and wrote that Aboriginal title is a prior and senior right to land. In the landmark decision, the court awarded Aboriginal title of some 800 acres in Metro Vancouver to the Cowichan tribes.
The original people who were here for thousands of years, like my community, you've got to look at the historic injustice that's occurred to the Cowichan Nation. We should all be furious about what's happened, and we should be focusing on how we make that right. So we're looking at the Government of Canada and the town of Richmond for the lands that are being returned, would have to transfer those lands over to the Cowichan Nation. And then the Cowichan Nation would plan how they intend to use that land. Looking at what does this parcel of land mean to the community? How are we going to maximize this for the benefit of everyone? But at the same time, not wanting to do to others what's been done to us. I would say no one is coming for the individual person's home. Nobody's coming for that. This is a responsibility of the Crown to negotiate with the Cowichan Nation, and that's our intention.
Canadian government officials appealed the decision to a higher court and sought to pause its implementation. Meanwhile, British Columbia also faces additional lawsuits and a separate ruling ordering it to uphold recent commitments the province made to Indigenous rights. Right now, the Cowichan decision has raised questions about how Indigenous land rights will be reconciled with private property in British Columbia. As you can see in this map, this line outlines the new area under Aboriginal title. It's a valuable slice of land. Property values within the area total approximately 1.3 billion Canadian dollars, or around $1 billion US, according to a review of the most recent tax assessment records. This is the heart of the area recognised as the Cowichan's ancestral fishing village. Today, as you can see, it's a busy industrial area full of warehouses used by the likes of Wayfair and Coca-Cola. People are wondering what the judgment means for areas with established industry like this. One of the estate's biggest developers said that they had potential financing pulled for a brand new warehouse planned for the site beside me. I'm currently driving through the residential part of the area that was awarded in the decision. The residents I spoke to are concerned, and yet they don't know what's going to happen.
That decision is totally wrong. The value right now, I wouldn't get no buyer. We can't sell it either.
Public opinion is shifting. British Columbia is often seen as the most progressive part of Canada. But now, half of its citizens say their province is giving Indigenous issues too much attention, according to the Angus Reid Institute. Politicians have been forced to weigh in. The left-wing leader of British Columbia, Premier David Eby of the New Democratic Party, was caught off guard by the sweeping nature of the recent court decisions.
The court decision, I'll be blunt, is a wrench into that important work that's been happening.
Pressure is building at the national level. Conservative leader Pierre Poilievre has sought to capitalise on the issue, urging the government to protect private homeowners.
We need to ensure that all future agreements that the government signs with First Nations clearly and explicitly lay out that fee simple private property is protected.
Prime Minister Mark Carney recently spoke about the Cowichan case for the first time.
This government fundamentally disagrees with the BC Supreme Court's decision.
So what happens now? Appeals and other lawsuits will take years. The court didn't settle how to reconcile Aboriginal title and private property, effectively leaving it to government. The Cowichan have said that the ruling does not erase private property. British Columbia says it wants to sign treaties rather than fight court cases. It's in talks with 29 groups, according to its Treaty Commission's latest report.
First Nations want to be part of the solution. They want to be part of the economic opportunity. We know from the Delgamuukw decision that Aboriginal title has an inescapable economic component, and the Cowichan Nation needs to explore that and be part of that and benefit from that area, and we're still in conversation about what that could mean.
The fallout from the British Columbia court ruling is beginning to spread to the rest of the country.
Canada's messy history dealing with First Nations is catching up to it. As uncertainty reigns, billions of dollars are at stake.
Coming up, we'll have a deep dive into national banks' earnings. Stay with us. That's next. Shares of National Bank are under pressure this morning, despite reporting a second quarter profit beat and raising its dividend by 8 cents a share. Let's find out why investors are not impressed with the latest earnings results. So joining us now is Ernest Wong, Head of Research at Baskin Wealth Management. It's great to have you join us.
Good to see you.
Why do you think, after all of this, shares are under pressure this morning?
So the big picture for National and quite frankly, all of the Canadian banks is that despite a pretty sluggish Canadian economy, there's issues with low immigration, tariffs, a weak housing market. Results are actually pretty good, and that is largely driven by their wealth management and capital markets businesses. So I think the key event for the Canadian banks obviously will be the upcoming renegotiation of CUSMA, and that will be the commentary we are looking forward to in the earnings call.
Okay, I was going to ask you, what were you looking for in the earnings, first of all? We can get to that point in a moment, and did you see it?
Yeah, so I think there were a few things we were looking for. The first is whether there was any indication of whether there was any impact of higher oil prices from the conflict in Iran on the consumer or on loan growth, and there hasn't really been any noticeable impact. The second thing we were looking for was just simply how the management was thinking about potential losses given the upcoming renegotiation of CUSMA. And while the management has lowered their economic forecast for Canadian economy slightly, it doesn't seem like they're expecting there to be much impact so far yet, given the dividend increase that they announced. And then lastly, I think one thing that is more idiosyncratic for National Bank is how their Canadian Western Bank acquisition is performing, what kind of synergies they are achieving, and that seems to be on track.
There is, though, just broadly, concerns about inflation, rising rates, rising mortgage fees. Will that weigh on credit losses going forward, do you think?
So I think what has become clear about the big six Canadian banks is that over the last couple of years is that they are really focused primarily on servicing prime borrowers. These are people who have good jobs, they have a lot of savings, they have good credit scores, and the big banks have really been focusing more on issuing mortgages and credit cards for this particular constituency of borrowers, leaving the subprime and lower credit worthy borrowers to the alternative space. And you're seeing that in the performance gap between the big Canadian banks and the private credit market and alternative lenders such as goeasy or Equitable Group. So while the concerns such as banking fees and those kinds of things certainly are an issue, less of a problem for National's borrowers.
We know National Bank has completed its acquisition of Canadian Western Bank over the last couple of years. I wonder how much of this quarter's upside was core versus that acquisition and one-time related fees.
Sorry, can you repeat that?
The acquisition of Canadian Western Bank. I'm wondering if you're seeing anything resulting from that acquisition. I know it was completed last year, but in the latest earnings results, how much of this quarter's upside was core versus that one-time kind of acquisition?
Yeah, so they've just lapped 1 year anniversary of the Canadian Western Bank acquisition. The last year has mostly been spent on integrating Canadian Western Bank into the National platform, such as retraining all the staff, moving the clients onto National's technology, rebranding all of the branches into National Bank. I think the next step is to start to generate revenue synergies. So things like selling wealth management to Canadian Western Bank clients and layering on other types of fee income, which is kind of what we saw in the quarter. And most of this work will be done over the next couple of years. We saw a little bit of it this year where I think they've generated about $33 million in revenue synergies from the Canadian Western Bank platform, but we expect more upside from this going forward.
Because how is it positioned National Bank in Western Canada, giving it more exposure on that side?
Yeah, so one thing that we've really liked about National overall is their ability to carefully pick areas of banking that they can earn superior returns in. So Canadian Western Bank is the latest example of that, where National has always been looking for a platform to grow outside of Quebec, where they are largely based out of. They looked in Ontario and they looked in BC, and there were already major Canadian banks that had large banking branch footprints there. So they saw an opportunity to finally make the acquisition of Canadian Western Bank, generate synergies out of it, and generate a good return. And that's something that National has had a great track record of, whether it be going into Cambodia or whether it be even acquiring a specialty lending platform in the US. And one of the reasons why we continue to own the stock.
Okay, so I wanted to get back to one of the points you brought up at the beginning of this conversation. You're watching for the earnings call for conversation about the CUSMA renegotiations, which are happening this summer, and how that could maybe impact earnings going forward. Is that right? Like, what in particular are you wanting to hear out of this earnings call on that front?
Yeah, so I think while the direct national exposure to tariff-related sectors is quite low, I think manufacturing is only about 3% of their book. There is, of course, going to be spillover effects from an unsuccessful renegotiation of CUSMA, where people are going to lose their jobs, they're going to have issues repaying their mortgages, they're not going to spend as much with credit cards. So these are all issues that we're looking forward to. Fortunately, I think that big picture, both countries are ultimately going to be motivated to get a deal done, because the things that the United States needs from Canada are things that they cannot easily replicate from other sources. And likewise, the Canadian economy obviously is very reliant on the United States and needs them as a trading partner going forward as well. So ultimately, we do think that while this may cause some volatility in National's results, which, by the way, may actually benefit their capital markets business, ultimately don't expect this to be a big event going forward.
Okay, we'll leave it there. Ernest Wong, Head of Research at Baskin Wealth Management. Appreciate your time. Thank you.
Thank you.
Coming up, we've got hot picks next. We'll zero in on 3 picks in the energy sector right after this. Stay with us. Okay, it's time now for Hot Picks. Today, we are looking at 3 Canadian plays in the energy sector. So for more perspective, let's bring in Nate Haywood, Managing Director of Institutional Research at ATB Cormark Capital Markets. It's great to have you join us.
Thanks very much, Lindsay. Appreciate you taking me on.
Yeah, the energy sector, obviously a very interesting topic of conversation, particularly in Canada over the last few months. Just before we dive into your specific picks, I want to take a broader look at what the sector looks like right now. Is Canada entering a new kind of energy investment cycle? Is this still just a short-term commodity rally?
Yeah, you know what, Lindsay, I would absolutely say we are entering a new cycle of investment. I think there's 3 main fundamental factors here that are really setting up for the midstream space. The first one being the higher commodity prices. I think if there's one takeaway from all the Q1 earnings releases, that everybody expects there to be a higher floor on commodity prices into the long term. So I think that should be supportive. The second being just more supportive sentiment towards large export projects. And that's whether LNG or crude projects are pursued. We're seeing a number of projects being proposed and moving forward, with some potentially making FID, notably the Enbridge Mainline Optimization 2 by this summer. And then the third being the confidence in the upstream space. Canada is obviously blessed with a lot of oil reserves, but also we have low decline rates, and we've seen some consolidation among the upstream players that should be supportive of volume growth within the basin. And I think that supports the midstream space, especially the incumbents that are operating assets currently and looking to do optimization and brownfield type of opportunities.
Okay, so with that, let's get into your hot picks then. Your first one is AltaGas. What is it that you like about this one?
Yeah, so AltaGas is a very uniquely positioned midstream company. It also has some utilities assets, but I think the most exciting part right now is on the midstream side and their propane export business. They ship propane to Asian markets. We've seen that those markets be disrupted by the Strait of Hormuz. About 1.3 million barrels of propane that usually reaches the Asian markets has been cut off. And so AltaGas has stepped in, and Canada has become a more secure, reliable player within international exports and providing propane and the energy that those countries need. I think that we've seen it firsthand with the pricing. The spread between the Asian price and the local domestic benchmark has more than doubled since pre-conflict. And I think that that's supportive of future contracts and the development. And so AltaGas is pursuing some growth projects with their export business, looking to essentially double their export capacity, whether that be through the initial phases of the Ridley Energy Export Facility or its optimization phases subsequent to those. So I think that that's really where AltaGas stands out, is their position with exports and providing access to global markets for local producers in Canada.
Your next pick has been in the headlines for the last couple of days, Pembina Pipeline, because of the Heartland Extraction Project. So obviously you're seeing opportunity there. That's your next one. What do you like about it?
That's right. Yeah, Pembina, I would think that this is probably the most diversified midstream player that we cover. It has exposure to natural gas liquids, and to crude oil, and it offers services from gas processing, fractionation, transportation, storage. And what we've seen for Pembina is recently they came out with a long-term guidance of 5 to 7% EBITDA fee-based growth through 2030. And that just provides a lot of long-term confidence in terms of what they expect to grow the business. And that guidance is really supported by the volume growth that they're seeing in the basin, probably around that 3 to 4% annually. It's their ability to provide their customers with increased market access, and then finding opportunities within Alberta as well. So having new catalysts for new demand. And as you mentioned, the Heartland project, the straddle plant they're developing, is directly supportive of the petrochemical business in Alberta and the industry there. But also it's looking at data center development as well, with the Greenlight project potentially making FID in a couple months. I think that this provides a long runway for growth, and having the diversified asset base, we really view Pembina as the incumbent here and going to have that advantage going forward, doing brownfield projects with very attractive economics.
Yeah, and you talked about some of these big projects off the top and how important this is for the sector to continue to grow. I wonder, just before we move on to your last pick, just very quickly, there's obviously a time crunch here to get these projects moving, to really capitalize on what's happening right now in terms of energy demand.
Yeah, I would absolutely agree. And I think that right now the industry is looking to move quickly on these newer projects. And hopefully, with lower or shorter review times, they should be able to move forward faster than they have been in the past.
Okay, lastly, Capital Power Corporation, your last pick. Tell us about it.
Yeah, just a little bit of different, more direct power exposure. Capital Power is one of 5 North American IPPs, or independent power producers, with over 10 gigawatts of natural gas power generation. And with that, it's a really strong play on data centers, both in Alberta, but also across North America. They've recently acquired assets in the PJM, which is a very attractive data center market. And they've also partnered up with Apollo to pursue M&A transactions and continue to grow their base. And so when we look at Capital Power, it's really a low beta play on the data center and that build out for AI infrastructure, where they're the incumbent, they're the company that's going to be able to grow and have uprates in terms of their smaller, more brownfield projects, because they already have the infrastructure in place, and they're able to grow that with the growing power demand. And that's not just data centers. There's also coal retirements. There's also electrification. There's a number of factors that are driving growth in power demand.
Okay, just lastly, any headwinds for these companies? There's obviously a lot of opportunity here, but anything that you're really watching for that could be a major headwind?
I think the volatility in commodity prices has been somewhat of a limitation. I think that many investors are concerned that with the strait potentially opening, we're seeing the crude price trade down today, that the commodity price might fall out a little bit. But as I go back to my earlier statements, I do think that the floor is higher. I do think that the setup is a lot stronger for midstream companies, for energy infrastructure players to serve a vital role in the sector.
Okay, we'll leave it there. Nate Haywood, Managing Director of Institutional Research at ATB Cormark Capital Markets. Appreciate your time. Thanks for joining us.
Thank you.
Coming up, from AI breakthroughs to a community-driven surge in innovation, Toronto Tech Week is showcasing how the city is redefining its role on the global tech stage. We'll talk to co-founders after this. Toronto is strengthening its position as a global innovation hub with Toronto Tech Week, uniting founders, investors, and operators amid discussions on AI, global scaling, and talent. For more on this, we spoke to co-founding partners and co-directors of Toronto Tech Week. Take a listen.
Community-led series of events put on by over 600 community hosts, organizations, small and large, who are opening their doors and showcasing Canadian innovation and talent all across the city. It's a citywide takeover this week.
Yeah, great that you guys are doing this. I mean, I'm curious to hear just stuff from the investor side. Are there a lot of VC funds in town? Are there a lot of deals getting done and companies raising capital? What's that sort of environment like around this week?
Yeah, absolutely. We have investors flying in from across the globe for Toronto Tech Week, which is really exciting. We also have investors from across the country in, and there's a lot of really exciting events. There's a lot of reverse pitch competitions, actually. So if founders are looking to fundraise, they can go and learn from investors directly. And equally, investors are here looking for deal flow. There are so many incredible companies, new startups, scale-ups. Like, there's really something for everyone. So whether you're an early stage founder or an early stage investor, there's events and opportunities for you, but also for growth stage companies as well. So we're seeing a lot of investor interest from across the globe for this week.
I wanted to ask about that because there was just a report that came out about how different cities in the country are managing to move away from the U.S. and Toronto is one of the more successful cities. Is it being driven by tech and AI? Then you mentioned all these people coming in from around the globe. Are we succeeding in that sector, in the tech sector?
Yeah, I think, great things happen when smart people are in the same room. And so there's a real opportunity for Canadian companies to raise from, other Canadian investors at Toronto Tech Week specifically. And there's so much interest in AI right now. I'm sure you guys have been talking about it a lot. And those are a lot of the conversations that are happening at Toronto Tech Week. About 60% of events that are happening involve something about AI. And so it's obviously such a hot topic and a top of mind for investors and founders equally. And so our hope is that by bringing people together, we'll be able to, help with deal flow, help deals get done, help founders fundraise, help talent find new roles at startups within the ecosystem. So our hope is that it's fruitful for everyone that's joining.
And how is AI changing the narrative around software? I know in the public markets, that's been a big concern as far as disruption around software companies. But for a long time, software businesses had been pretty hot, and I think raising a lot of capital from VC and growth funds. I mean, are there software companies that are participating, or is that less of a focus, I presume, this year?
There's still a ton of software companies that are participating this year, like large software companies. And so, things are changing rapidly, but these companies are obviously still exist and play such an important part in our ecosystem as well. And they're changing and they're adopting, new AI practices as well. And there's still a lot of involvement, but we're also seeing some really exciting new tech and AI companies come forward that are brand new startups and that are building and raising during this week.
And is there one subsector that's kind of standing out this year where you're seeing more interest or more founders showing up for that subsector?
I mean, there's so much that's happening. Yeah, I wouldn't say that there's one sector that's showing up more. I mean, this Toronto Tech Week is an open platform for anyone and everyone to get involved. And so we are seeing a huge diversity across all sectors, industries, even like hospitality groups also. So Toronto Tech Week really is a citywide takeover. Whether you're in tech, you're wanting to get into tech, there's so much happening. And so I think there's a pretty nice and diverse set of events happening across all industries and sectors this year. Yeah, I will say too, there's actually been a lot of hardware tech companies. And I think that's been really interesting. I think we were all, really ready for a lot of AI events and topics. But hardware has been a big part of Toronto Tech Week this year. And so it's been really cool to see the robotics community come into play. And that's been really exciting for us to see.
And as part of the idea behind what you guys are doing with this conference to sort of just spur more innovation in the Toronto tech community, and is that like, are you seeing that sort of behind the scenes with new companies starting in Toronto and sort of a growing community of AI innovation and things like that?
Yeah, well, Toronto already has one of the most vibrant tech ecosystems in the world. And so, but what it didn't have was really a shared moment where the ecosystem could come together and showcase what's being built here. And so really, this is an opportunity for founders, investors, operators, researchers, students, global technology leaders to connect across the city and really highlight the scale of innovation happening in Canada.
And are you seeing results? And the big concern, I think, there was also an article I saw this week about the brain drain. Are you finding Canadians, specifically people from Toronto, are staying in Toronto, or is that the legitimate? They get some funding, they get some success, and they head south usually?
Yeah, well, part of the reason why Toronto Tech Week was started was actually to address the brain drain specifically amongst our younger talent pool. And so it's really important to us that we show young people what great looks like and that they can build successful and fruitful careers and companies in Canada. And so what's been really exciting for us this year is seeing so much student and university involvement this year and seeing a lot of young founders come out of that as well. We actually started a student ambassador program with university representatives from across, the major universities across Ontario. And they've been instrumental in bringing young people into the fold. And so our hope is that by, bringing them into the same rooms as these incredible leaders, that they'll be able to understand that they can build fruitful companies here. And if they are building, then hopefully we're helping them find investment, talent, or, clients as well. And it's such a great question because companies like Shopify and Cohere have shown that globally relevant companies can be built from Canada. So one of the most important conversations right now is how Canada continues to retain top talent while creating an environment where founders can scale ambitious companies here long term. So.
And are you working at all with any of the sort of the faculty of some of the leading universities here, whether it's U of T or Waterloo, to where there's been a history of tech and innovation, and are they involved in the conference, or are there programs sort of starting to focus on AI and things like that?
Yeah, we were actually both just at U of T yesterday. So Reynolds Zinn of Databricks and Mike Murchison of Ada were speaking about the future of AI and building, $100 billion company brick by brick. U of T has been instrumental in Toronto Tech Week. They've really taken it and ran with it, which has been awesome to see. But we've also seen involvement from McMaster, Waterloo, McGill, even TMU. So many universities have been involved as well in getting their young folks involved.
And that was the co-founders and partners and co-directors of Toronto Tech Week. Okay, we're going to take a last check on the markets before we wrap things up here. We'll start with the TSX. It's down today by 0.2%, so seeing some losses after seeing some losses yesterday as well, particularly driven down by the energy and materials sector today. We'll take a look at the biggest gainers on the TSX. Bausch, Shopify, and Colliers are all up today. Bausch up by more than a full percentage point, almost 2%. Shopify up by almost 4%, and Colliers up by more than a full percentage point. This one after it made an acquisition. Not clear why Bausch and Shopify are up so much today, but they are the biggest gainers. In terms of the biggest losers on the TSX, you've got Aura Silver, Curaleaf, and BlackBerry. Aura Silver down by almost 5%. Of course, we're seeing the materials sector lagging quite a bit, as I said, on the TSX, so that's dragging things down. Curaleaf down by more than 7% today, one of the biggest decliners on the TSX. And BlackBerry down by more than 3%. We're also, of course, following Canadian banks. We've got a couple reporting earnings today, a couple more tomorrow and Friday. National Bank reported earnings today. It seems as though investors not too happy with what they saw. National Bank down by almost 2%. Bank of Nova Scotia up by almost 2% after reporting some pretty robust earnings. And the Bank of Montreal is up, but not as much, up by about 0.4%. To start the day. We'll keep watching that to see how those banks fare throughout the day, whether investors feel a little more confident in them after seeing those earnings. And we're taking a look at U.S. markets today as well, keeping an eye on what's happening there. Mixed trading so far today by the S&P 500. The Dow Jones is up by 0.5% and the NASDAQ is down. Zscaler is one company that we're watching closely south of the border. Zscaler plunging. It's down more than 30%. Take a look at that on weak guidance. So we're continuing to watch that. Seems as though people are not happy. And we're also watching Bath & Body Works as well to see how things are faring there, up by almost 15% at the moment. Okay, that wraps up this edition of The Open. Morning Markets is up next with Roger Peterson. Stay with us.